At the core of this training program is our grading methodology, so let's cover that first. Essentially, what we're trying to do here is take complex statistical measurements and apply the results comparatively across the grading scale. The grading scale uses B- as the average, which does give a few more grades on the higher end, and initially we used a C, but it didn't make very many investments look as appealing, so we moved it around and found that B- provided a good balance. This method came about because I had a hard time understanding how to apply the statistics that they teach you in these finance courses to making real world decisions. And, that might sound silly, but it's not that I didn't understand the statistics. It's more like I would analyze two stocks and get two different Sharpe measures. And we'll explain that more in a little bit. But say one stock was a 0.34 and the other was a 0.51. Now, obviously, one number is higher than the other, but I wanted to know what that meant and how those numbers compared to other investments that are out there. Like, was I making the best investment that I could? And how did it really compare to those other options? So that's where a lot of this stems from. It was just a drive to translate all these statistics into something that was relatable to me. And after doing a lot of testing, I arrived at two different grading concepts. One for stock grades, for comparing the performance of the different statistics across the population of investments. And the second is for portfolio grades, to help you identify where the risk is coming from in your portfolio. So let's take a closer look. With stock grades, just to give you an example here, the grades are distributed across the grading scale like we just discussed, and that's done for each of the 5 different metrics that we offer. The higher their result is, the higher up they are on the grading scale. And while this may seem simple, in our tools you can change the grades to be based on up to 5 different metrics and even incorporate different historical time periods so that you can better leverage different strategies. And in Portfolios 400, we'll go through the performance of the different strategies and how, in our opinion, is the best way to leverage each. All you need to know for now is that the grades will change based on the metric you're using for stock selection. The second letter grade is the portfolio grade. This grade is designed to help you identify the asset's contribution to the overall risk in your portfolio. And as you can see in this example, the first letter grade is the letter grade that was assigned based on the statistical measure, and the second letter grade is the grade that's added to identify the asset's contribution to the portfolio's risk. So a lower letter grade here indicates that the asset is contributing more risk to the portfolio. The asset adding the most risk to the portfolio we designate with the letter R. You can see one stock here with a B+, and another with a C, and then when you combine them, however, what you might find is that they don't interact all that well together. And what that means is individually they might be great choices, but when combining them with the rest of your portfolio, maybe they don't interact in the right way and they're forcing you to take on more risk. So in working with the second letter grade, A isn't always necessarily what you're striving for. You want to use it just as a point of reference. It just shows you where the risk is, and you don't want to eliminate risk from your portfolio. You do want some because that's where your return is going to come from. But what the grades can help you do is compare fits and different combinations in an effort to identify the right stocks for your portfolio. For example, you may want to include like a hotel stock in your portfolio, but as you go to add the company, the one you thought you wanted to invest in, you find out that it doesn't interact well with some of your other investments. So maybe you try out a few other companies in that industry and you may end up finding another one that actually works out really well with the assets that you already have. So think of leveraging these grades as a way to help you narrow down your choices and find the right investments for you. A lot of times I'll use portfolio grades and start with maybe like 20 stocks initially and review the grades and then narrow it down to what I consider to be like the best 12 or maybe whatever quantity goal I have in mind. And to me, that's part of the fun. And if you can understand these two grades, then the rest of this should be pretty fun and easy. So once you have your stocks compiled, what's next? How do you know how much to invest in each of them? And that's where this concept of portfolio optimization comes in. Finding the optimal portfolio is an important part of how professionals decide how to arrange their portfolios. And you need to understand that optimization does mean something mathematically. And we'll explore the specifics of that later in Portfolios 200. But essentially what that means is that you take the assets that you want in your portfolio, and then the computer will test a whole bunch of different combinations and see which ones produce the highest return while taking on the lowest amount of risk. Optimizers will then show you that set of weights from that optimal portfolio, and then those are the weights that you want to use when making your investments, since out of all the potential combinations that were tested, those are the ones that perform the best. And in the example here, we do have another letter grade associated with the optimal portfolio. This letter grade is associated with where the portfolio's Sharpe measure falls within the overall population of the stock Sharpe measures. And that's just there to give you an idea of what kind of investment you built. The combination of all of your investments is the vehicle that you're building, and we just want to give you a comparison to what's available in the market.